they forget about that structure ahead of time.
Absolutely. And the point there again is that if you want to be able to use the capital gains exemption, generally the shares must have been in existence for at least 2 years.
Life, money, action.
Welcome to Small Change, Big Gains, the podcast where we explore how small, intentional decisions can lead to major results in your financial life and personal growth. Whether you're looking to invest smarter, develop better habits, or simply find balance, we'll learn together how minor shifts can make a big impact. Join us as we unravel experiences, explore practical tips, and hear inspiring stories. Let's make it happen, one small change at a time towards big gains.
Thanks for tuning in, everyone, to another episode of Small Change, Big Gains. Amy, 'tis the season to be sad. Tax season's right around the corner and just literally maybe
season. Isn't that great?
Yeah. Well, one thing I wanted to, we've always been questioning and I've always been asking myself is short-term tax consequences. Like, when around this time, all we're thinking about is the past, right?
Yeah.
Past year. How much tax do we have to do, or how much taxes we have to...
We're all running around with our hair on fire getting tax slips and all those things that we need to start, our accountants are starting to ask us for.
Exactly. But what about the long-term consequences of taxes, right? Like long-term structures and all that stuff. What do you got for us?
Well, we're super fortunate today, especially because it's tax season. So to talk to any accountant right now is a very, very busy time. So we're super appreciative that Ali Spinner with Crowe Soberman, accounting firm here in Toronto, she's taking a few minutes out of her day to come and talk about the longer term tax. And longer term tax can be massive, massive dollars in people's pockets.
Absolutely.
If they plan properly. Mm-hmm. And so she's got some actually great strategies and some really great ways to simplify this whole complication around corporate tax. We work with a lot of business owners, and this is a topic that comes up time and time again. And
very important. Yeah.
She covers this beautifully, and she will definitely be back because this is a great chat. So coming up next. Welcome back, everybody. We are joined today with our special guest, Ali Spinner, partner at Crowe Soberman here in Toronto. Ali, we're so excited to have you here.
Thank you for having me. Excited to be here.
It's we're super fortunate because this is really an accountant's busy time of the year. So thank you for making time. Because
no problem.
We're hearing it from our clients. Everybody's getting ready. There's a whole lot of stuff going on. But what we wanted to talk about today specifically, because Joel and I are talking, a lot of our listeners are business owners, and that tends to be who we work with. And what we often find, people are starting companies. They go out. They want to get paid, so they quickly put together some get incorporated, not sure what, common shares, preferred shares, copy what their friends did, put it together, and then away they go. And then only later on, they go,
many years later.
What was that about? What do you mean? Why do I need to do that? Now I need to change. And then they call you at that point. But what we wanted to talk about is, what should we be thinking about in the beginning? Like, how should we structure and plan ahead, and like, what should we be doing?
That's a great anecdote because it's not unrealistic. It happens all the time. Yeah. And the good news, if any of your viewers or listeners find themselves in that situation, is that it's often, not that it's easy, but it absolutely can be done in many circumstances to reorganize the way that your business has been held,
right,
if it's not in the way that you perhaps want it to be held in the future.
Yeah.
And that's for another session.
Yeah.
But let's go back to the beginning if it's okay there.
Yeah.
So I love the way that you phrased it. And in a perfect world, before the business is off the ground and running, or before it's made any real money, I'll say, it's always great to think about, well, how should this business be organized? Mm-hmm. What should the structure be? Mm-hmm. And I have some different comments and different ways we can think about it. The first thing we always have to think about is, even though we're just starting the business, I always like to think about the short term ahead and the long term ahead.
Right.
Are we planning for income? Are we planning for income that's going to be generated every year? Mm-hmm. Are we planning for income that's going to be used to pay for personal expenses, or is it going to be money that can be reinvested back into the business? or into an investment portfolio. So I would call that planning for income.
Okay.
As well as, are we planning for sale? And
Okay.
it's possible to do both.
Right.
It's possible to do both, but it's always important to make sure that you don't want to plan for sale
Right.
if this is a business that's never going to be sold. And what I
Okay.
mean by that is maybe it's all personal goodwill, meaning
Well, that's
that
a really good way to break it out. That's God, that's so
Planning for
simple.
income
Why?
versus planning for
right,
sale. I
right.
like
And
that.
not every, and it's interesting, not every business that gets started is saleable.
Correct. Yeah.
For example, I'm just thinking if you have, a consulting business where you're the sole consultant and you're
Exactly.
able to incorporate, you're never really going to sell that business because there's nothing to buy.
Right,
So
right.
in that case, you're really only planning for income.
Right.
Versus you might have a company that's going to be in the tech space, for example, and you're really planning for a long-term sale and you're not planning to have any revenue or any profit in that business. You're not really planning for income, you're planning for sale. So it's always important to make sure from the outset, even though it's early days,
Yeah.
what's the future, short-term and long-term.
Right.
And Canadians do tend to get a bit nervous. Oh my goodness, am I going to be stuck with a whole bunch of professional fees to set it up? It doesn't have to be. And as I
Right.
mentioned at the beginning, even if you start down one path, it is definitely possible as the business grows in value to reorganize later on.
Right. Right.
I'll say generally in most circumstances. So that's really important as well.
Right, right. Okay, so asking for a friend. What I often see too is, okay, business owner sets it up. They're independent at that stage. All of a sudden, to your point, I didn't plan for my family. I don't have my spouse included. Maybe I've got kids. What types of things should they be thinking about when they get to that point?
Okay, great question. And I'm going to frame it back in this concept of, are we planning for income or planning for sale? So the good news, it's actually not great news, but the good news, because it makes things pretty simple, is that if we don't have family members who are actively working in our active businesses, assuming this is an active business, generally we cannot pay them from those businesses without having what I'll call adverse tax consequences, meaning that we would pay high tax on those dollars sent to those family members. I get the question all the time, how much can I pay my spouse? How much can I pay my kid? And the answer is, well, if they're not working for your business, the answer is nothing, right? So I'll just get that out of the way.
Yep.
So when it comes to, of course, if we have active family members in the business, you can pay them a reasonable salary based on what you would pay to anyone performing that job function in that space. So that's really important.
And there's a test, right? There's like reasonable tests that they would say, like, you can't just say,
Of course.
work, 2 hours a week or something. It has to be a meaningful.
It has to be reasonable in the circumstances for sure. There was probably back maybe 5-6 years ago when this concept of splitting income with family members was really under a microscope in Canada.
I remember that.
Someone made a really funny comment about how, I can't remember if it was the Canada Revenue Agency or the Government of Canada who had hired a social media coordinator for 6 figures. So they're like, great, I know what my kid's going to be doing this summer. So it wouldn't surprise me if there's a lot of well-paid social media coordinators. But to your point, in all seriousness, the amount paid to the family members must be reasonable. But let's talk really about the structuring of it. So I'm going to take this concept of paying family members out of an active operating business away for a second. We can come back to that. But generally, when we have family members, I start to think of, okay, this is where we can get into future sale planning, where business owners and Canadians can really make their mark, if you will, is if they plan for the capital gains exemption. As your listeners may be aware, every Canadian can earn on the first. The numbers are always changing because the government can't quite seem to pass legislation these days, but it's around.
That's such a nice way to say it, Allie.
I'll just say it's about $1.25 million. So on the sale of an active Canadian business, on the first $1.25 million of gain, every Canadian can earn that gain and pay zero taxation or pay no income tax. It's true, there might be some alternative minimum tax. Again, that's for tax 2.0, 3.0. But we'll go on the assumption of there won't be tax, and the savings could be in the range of $300,000 to $400,000 per person.
That's a lot.
There's a lot of money.
Big deal.
So if I sold my company for $5 million, the first $1.25 million is
tax-free.
Tax-free.
Correct. And so, of course, when we have family members, we want to make sure that every family member could maybe have some ownership of that business. So that if there is a sale, the entire family could benefit.
So in that example of a $5 million sale, it's not just one person's $1.25 million, it's the family members.
It could be multiple people.
Got it.
So the question comes down to, do you want to have family members? Do you want to have family members have direct ownership in this business? Which is, it's easy to give people direct ownership in a business at the beginning when the business is worth nothing because people are just subscribing for shares at a very nominal value.
Right.
Or would you, as the business founder, like to be able to decide if you benefit some family members down the road, but maybe not make up your mind today and perhaps use a family trust to provide some of that flexibility? I'm glossing over some very technical
but
points
from a high
here.
level, right?
Yes, from a high level, the family trust is what would be able to allow flexibility where we do see business owners have the growth shares of the business owned by a family trust, the purpose of which is that on a future sale down the road, if the shares owned by the trust qualify for the capital gains exemption, then that gain can be distributed to different family members and multiple people can benefit from the capital gains exemption. Now, the big but I'm going to say is, so number one, I would not just suggest that people all just run out and use family trusts.
I was going to ask.
Lots of things to consider. But the most important thing I would say as well is that if you're going to have family members in these trusts, and if you're going to, quote unquote, use that person's capital gains exemption in the future, you have to be prepared to give that person money. So this is not many, many years ago when I started in my career, people were, I think, more apt to allocate. I'm not saying that this was correct, but we would see this happen more often. People would allocate gains to family members and then scoop the money back. No,
I've always wondered that because we've had this chat. I go, so if I use my kids theoretically and then I pocket it, and then in future, if they have their own business and they never got to use it at all,
well, that's another fair point.
Problem,
so number one is you have to actually give that child the money, or at least hold it for them or spend it for their direct benefit. And number two, that's a great point as well. And I have that discussion with clients. Is it fair for a parent to use up their child's capital gains exemption? Yes, you are giving that money to the child. Maybe you were going to give the child the money anyway. But now it means that that child in their own lifetime, unless the capital gains exemption continues to grow, they won't have the ability to use the capital gains exemption in the normal course of them starting a business. So there's many schools of thought. There's no perfect answer here. But I would definitely say if there is a business that is going to grow in value, if the business is going to grow in value, if it's an active business, and if it is primarily a business with assets and if assets in Canada, and it could be a business that qualifies, then it's very important to consider if this should be a business that's structured in a way to multiply the capital gains exemption and potentially benefit down the road on tax savings. And these would be absolute tax savings, and that can be really meaningful and key.
That makes sense. So your point going back to earlier, don't rush out and just put these trusts in place, because that was going to be my next question is, when do you know when to put that in place? Like, say you get down the path, it's like at what stage? Because sometimes we hear there's that deemed disposition upon trust, that 21-year rule. And so it's, if I put it into early, is that going to be an issue? When should I start thinking about that?
It's a great question, and the answer might be different for every single person. On one hand, I would say, well, if you do get it in there right from the beginning, it's going to be the easiest time to have the trust in the structure because there's no value accruing to anybody. As well, if the capital gains exemption is going to be used, we will need that trust to have likely owned the shares for a period of 2 years' time. So you need a bit of a runway. And you need enough value to accrete to the shares that are actually owned by the trust. So if you have a
let's
business,
just say that one more time, that 2 years ahead of time. So every business owner that's looking to sell your business, please listen to this, because I hear the stories after the fact of, I wish I would have known that. I didn't know that, because they get so focused on the sale and the sale price, they forget about that structure ahead of time.
Absolutely. And the point there again is that if you want to be able to use the capital gains exemption, generally the shares must have been in existence for at least 2 years. There's various other tests as well, but I think your point is really critical in that if you want to make sure that you're taking advantage of tax savings and efficiencies upon a sale, this is something that you do have to start a couple of years in advance so you can plan for it.
So I'm not just being a naggy planner. When I say plan, I get the eye roll like, oh, a planning. I'm like, no, but there's real tangible money behind it.
And so the other point is that often what will happen is that somebody will come in and say, okay, I want to reorganize my business. I want to have it I want to put some shares into a family trust so I can use the capital gains exemption and multiply on a sale. But what I also mentioned is that the shares that are owned by the trust of the operating business have to have value. And if you have a business that's realized all of its increase in value at a point in time, and if it's not going to continue to increase, there's going to be an issue even if time is on your side.
Right.
So that's why in a perfect world, everyone would set up perfectly from day one. We'd have lots of time. We would have values accruing in the right spots.
Yeah.
Perfection is not necessarily the goal.
Yeah.
But definitely catching the structure a couple of years in advance to give us time to both have the company be as pure as possible from this point of view of making sure the shares qualify in the first place, but also that enough gain or value accretes to the shares owned by the family trust.
That makes sense. That makes sense.
I'm a little confused when you say like the shares have to have value, for instance, right? And there still has to be growth. Can you elaborate on that a little bit?
Sure. So if you have a business, let's say that I'll use the word terminal value. I'm not in finance. I could be using it the wrong way. But let's say the terminal value or the sale value is going to be $10 million one day.
Yeah.
And let's take one example where it's day one of the business. The value is nothing, right? The value is zero. And that value is going to grow over time to 10 million as the goodwill of the business grows, or something within the business has to grow in value. If we have that family trust in place in day one, then the growth shares will eventually grow to $10 million. Right. But many times what will happen is a client will come to you and the value of the business might already be at $10 million. Right. And they might say, okay, I want to position this company for sale. What do I need to do? But if the business owner already owns shares of the business that are worth $10 million, it's true that we could implement a freeze, perhaps, freeze the value of the $10 million equity value in the business owner's hands and put future value into this trust. Yeah. But the point is that there's already been $10 million of value that's embedded in the shares owned by the founder. Yeah. You can't just magically wave a magic wand and move value away from the business owner into the family trust.
So that's what you call an estate freeze, isn't it? Or what do you call it?
Yes, that is an estate freeze. I would say in this case, it's not necessarily, this is an estate freeze or a freeze, not for the purposes necessarily of minimizing tax on death or capping tax on death. Right. But it's really to capture value in one person so that future value can accrue somewhere else, so that future value goes to this magical entity known as the trust to be able to then have the gain allocated to multiple beneficiaries if the trustees so determine at that time.
Right. Gotcha. So going back to your earlier point, planning for income, planning for sale, that structure we just talked about is typically for planning for sale. Correct. So what's the difference if we're going back to planning for income? Yep. So I've got a successful business, probably not saleable to your point. Maybe it's more of a consulting type role. Maybe I have clients that I can maybe, pass that on to somebody else, but in all intents and purposes, it's for income. Yep. How should I be thinking about structure?
Okay, great. So the first question I'm going to have for you is there any liability risk in your business? If the answer, it's very interesting as I'm saying these words, I'm seeing the decision tree pop out of my mind. But I think the first question is there liability concerns in your business? If the answer is no, and the answer is you're never going to sell your business, you can just leave the leftover profit in your business. You can let the investment assets build up in the operating business, if it's consulting or whatever it is, and you can have them invested at the corporate level, which of course is only subject to the lower corporate tax rates, not personal tax rates. Right. And the investment portfolio can grow in that corporation. If there's a liability concern in the business, meaning that we don't want to keep investment assets inside of the corporation, right? Because God forbid, an unsecured creditor comes along,
right? Or you get sued or something,
exactly against the company, and somebody would have access to it. We then want to turn to ways and say, okay, well, how can we use this money, this pool of assets, cash that's been subject to only the low rates of corporate tax, and move this money into a different corporation on a tax deferred basis, so there's no additional tax for moving money from company one to company two. Right. Usually what we do is we pay an intercorporate tax-free dividend, assuming that we're not in the world of refundable taxes. That's for 2.0, 3.0. And so I would go back to the question of, well, number one, is this a business that can be sold? And if the answer is yes, then we have to plan for the capital gains exemption, which I'll get to in a second. Yep. If the answer is no, and it's a business that's not going to be sold, we're throwing off excess cash, and we want to have that excess cash out of the operating business, we can very simply have a holding corporation interposed between the founder and the operating company. Right. We can have the operating company then pay dividends up from the operating business to the holding company. Yep. And that holding company, which is now the sole shareholder of the operating company, can be used to fund investments. It can build an investment portfolio there. So we've achieved the goal of taking out the excess cash out of the operating business, parking it in a very tax efficient way into the holdco/investment company and investing it there. If we have a business where we will have a potential sale, and if we have a potential sale, whether or not, well, let's use the example of, yes, we do want to multiply the capital gains exemption and we want to use a trust. What we very often do is we will have the trust become the owner directly of the operating company. I'm assuming in this case, I'm making a very simple owner. We would have the trust own the operating company, and one of the beneficiaries of the trust could include a corporation that is wholly owned by one or more of the beneficiaries.
Right.
Meaning that, and you might have to visualize this in your brain, but now we have operating company held by trust. One of the beneficiaries off to the side is a corporation that the founder owns. What happens is that the excess cash that's built up from the operating business can move up into the trust. The trust can allocate that money, that dividend, out to the beneficiary corp. No additional taxation. We get back to the same result where we've pulled excess cash outside of the operating company. We've parked it in a corporation with no additional tax, very tax efficient from an income point of view. And we've also been purifying our operating company such that down the road, if the trust's going to have a sale, the shares can still qualify for the capital gains exemption, and we can still multiply.
But you've taken that income or that investment out. Got it.
That's that I want to say is my preferred scenario. I really like it.
And that distant beneficiary, the corporation, the beneficiary of the trust, is that the holdco? Would it be a holdco, or it could be even? It's
a holdco that doesn't really hold anything. There's no direct ownership between the holdco necessarily and the operating company. There could be. I've seen situations like that, but effectively that company is used to house the assets, the excess cash that's generated from the operating business to be used to fund investments.
Right.
Yeah.
So in that scenario, or even in the one previous, so you've got money from OpCo goes to HoldCo. You're sitting there, you're investing. That's where we come in. We do all the investment part. What about some of the planning with families? Because if it was the one business owner, they've got this chunk. Now they've got a spouse and kids. What should they be thinking about in terms of the structure? Where do they fit in?
So this goes back to the age-old question, which we've had, well, I shouldn't say age-old, but in the last 7 years or so, this concept of splitting income with family members, we generally don't have it anymore. So splitting income we can split income in the sense of...
That's because CRA came just cracking down on it?
Yes, it was a Department of Finance that came in and changed the rules. We have this thing called TOSI, tax on split income. There's all sorts of different things that go on there.
TOSI sounds so nice, but it's so evil.
Well, it was very interesting. If you actually go back and you read the Department of Finance explanatory notes when this came out, it's kind of comical to me where they note that it's very interesting that all of a sudden all of these 18-year-olds and 19-year-olds, kids who are in school, are all of a sudden receiving very large dividends from private corporations. Well, of course they are, because they have no other income, and it was a great way to put, I don't know, about $50,000 of income into someone's hands and have them not pay any tax. The long and the short of it is that generally, from this point of view, this is not an income splitting play on a current basis. It would be for the long term, meaning that if there's a sale and there's a capital gain, and that capital gain is going to be allocated to different family members, that could work.
Okay, that makes sense.
Ali, I remember in the preliminary chat we had, you said with trusts you can have your cake and eat it too. So it definitely sounds like you can.
You can. I mean, I would say to a point, and I absolutely want to caution everybody listening and watching that these are not to be taken lightly. They do, and I'll explain the have your cake and eat it too. The reason I mean that is that you can allow growth to accrue to this trust, but the trustees don't have to determine for up to 21 years, because we talked about the 21-year rule, the trustees don't necessarily have to determine who actually is going to own that growth in value. The reason why I'm saying 21 years is that in Canada, a trust every 21 years, a trust like this must realize the gain on its assets, or immediately before that time, it must pass those assets out to its beneficiaries without realizing the gain. So there's a 21-year time horizon in which we can decide who's going to get certain assets. And the reason I also say have your cake and eat it too is it allows for a structure where we can plan for both income, moving the income up through from the operating company through the trust to the holdco, and also at the same time allows to plan for the future capital gains exemption multiplication.
Yeah.
One thing I will say again, I know I'm very cautious, but with these family trusts, we do have to be considerate of some of the hair that comes along with having the trust. And that can mean anything from the beneficiaries of that family trust. If, for example, somebody has their children as beneficiaries of that family trust, you may want to have your children have marriage contracts before they get married to make sure.
Funny you should mention that. We just did a chat about
but
that.
It's
Marriage
incredible.
contracts.
Yes.
There they are again.
You hear that, Daniela? We should have marriage contracts.
It's very important because the beneficiaries have an entitlement that the courts of family law see different than other courts, perhaps. And if you want to have that, the situation, of course, is that the parent is saying, "Oh my goodness, what if my child gets divorced?" And then the in-law child says, "I have a claim to this asset."
Yeah.
So that's why whenever my clients put in family trusts, I always explain to them, if you're going to do this, make sure that you have the marriage contract. Not everybody wants to have that marriage contract done. Many do.
Yep.
It's definitely a consideration. There's all sorts, I don't want to say there's all sorts of things that can go wrong. There are.
Yeah.
But maybe that again for the next podcast.
But I think that's why it's so important to have a conversation like yourself. And by the way, you're very good at explaining a very complicated structures, right? These things are very complicated. People get, when you start to get down into the weeds of it all, but you're able to bring it up at a high level so that people can visualize and understand some of the moving parts. It's incredibly helpful for planning purposes.
Yes.
So
thank you.
Thanks, Ali.
That's very helpful.
Ali, I just had what was my question? Oh my gosh, it just left me. Actually, so all that sounds very great and very prudent and beneficial. Why don't a lot of business owners probably take advantage of that?
It's a great question. So number one, well, some do.
So I'll just
Not
I just want to say
everyone,
because it
definitely
never
not
popped
everyone.
into my head, and I know like a lot of my friends, for example, that own. I'm not going to say the most successful businesses, but a lot of for example, tradespeople. They incorporate and then they start they go out there, do their own thing after they get their apprenticeship. But a lot of them, this stuff does not cross their mind at all.
So I have a few different answers to that. Sure. So number one, it goes back to the concept of, do they have a business to sell? And many tradespeople do. If they're building up goodwill, if they have employees, things like that. The other thing to keep in mind is that with a business, and again, it goes back: are we planning for income? Or are we planning for sale? If we have a business that is only producing enough income to sustain ourselves and the other shareholders in our personal needs, meaning that we don't have cash to leave behind in the business,
right,
there might not be any reason to incorporate, assuming that we don't have something to sell.
All business owners really start to collect cash, or is it just...
They collect cash, but they still... It's very expensive to live in the city of Toronto. Yeah. I should start the business that you're starting. Yeah. So there's two things. One is that, let's say there's a business owner and they net $500,000 of profit before they've paid themselves.
Right.
That business owner, now they have to think about, well, what's my personal cash burn? How much money do I need to fund my living expenses, whether it's a mortgage, tuition for for school, summer camp, daycare costs, clothing, food, vacations, RSP contributions, the whole bit. So when I work with my clients and we discuss the decision to incorporate in the first place, the first question I have is, well, how much profit do you have and what's your personal cash burn? And we work back to see, well, is there even a surplus of cash that's going to be left behind that you do not need to fund your living expenses? The answer is going to be different for everybody, and everybody's living expenses are different. Then the other piece that I also say is that even if your living expenses are zero, I always remind my clients that we don't pay top rates of tax on $1. In Ontario, we pay 53%, on dollar about $250,000. And there's savings on $0 through $250,000. The savings are about $45,000 per year per person. So generally, when I have business owners, even if they don't need the $250,000, which is pre-tax, but even if they don't need that to live off of, it generally still makes sense to pull that money out of the corporation each year to soak up all those marginal rates of tax and save
really,
the $45,000.
I thought you might want to keep the money.
No, because then what happens? And I love that you're asking this question.
Yeah,
and I'll give the example for a second of the young. I'll give the example of the young medical doctor just out of school.
Yeah,
and what's fantastic for the medical profession is that many of them out of the gate, once their residency is done, they can or they can start earning lots of money really, really quickly.
Right.
And there's lots of assumptions of, they must incorporate right away. And the discussion
I had that.
and then so the discussion that I have is that, okay, so if you incorporate, and even if you might be living with your parents, you might not have any debt, you might not have a mortgage, who knows what it is. Even if you're saving up a whole bunch of money, when you're early on in your life and your career, I say this with in retrospective 25 years of practice in this area. So just from what I've seen and in my own life, the way that life twists and turns.
Yeah.
So even though you might be able to save tons of money in those early years, so number one, if you're not taking out the $250 every year, that $45,000 of savings goes out the window. It's not like RSP contribution room. And then what happens is maybe you don't need the money in year 1, 2, and 3, but then in year 4, maybe you get married. Maybe you decide to buy a house. Maybe you want to go blow it all and go on a whirlwind vacation. Exactly. Vacation. But the issue is that if that money, if you're able to leave it behind in year 1, 2, and 3, and you pull it all out in year 4, all that money that you're pulling out in year 4 that you could have pulled out in year 1, 2, and 3, it's all coming out at 53.5%.
All right. So by pulling it out earlier, you can fund your TFSA, your RSP, like do all of that sort of stuff. And then you have the flexibility on the personal side to take advantage of all of that. Oh, that's
so interesting.
If you think about it this way, $45,000 on $250 is about a 20% rate of return.
Yeah.
If we could all know that immediately 20% rate of return is great, maybe we'd be willing to give it up. But by pulling the money out over time, we're effectively averaging down our tax rate. So I'm not saying that we shouldn't incorporate right away. I'm saying that we should give it some pause for consideration.
Think about
to make sure that it's the right time. The only downside to incorporation is cost. There's cost, there's fees. You have to keep up with respect to the company every year going forward. And the nice thing too is that if you have a business, generally you can always incorporate the business in the future. So often I say, you know what, just start, see what happens. And if it gets to the point where you've got so much money that you realize you're not spending and you're building up your investment assets, they're growing at a substantial amount, then we can incorporate at that future point in time.
Ali, I've learned so much today.
I know.
I'm going to warn you, we're definitely going to get you back on because
no problem. Happy to be here.
I still want to ask you, for instance, like when you incorporate preferred shares versus common shares,
I know. Like we're going to have to bring you back.
We're definitely going to have to bring you back
conversations, but thank you for making it so understandable.
Happy to be here.
I think that's very rare for what we've been able to see. It gets very complicated. We go down these very confusing paths, but this is from a high level, I think, some good starting advice to engage a professional like yourself to say, this is what I'm thinking. And I love the way you broke it down. Are you planning for sale? Are you planning for income?
It might be both.
It might be both, but at least think about those things to figure out which path you start to go down and not get
And then even next time, like for example, as a business owner, paying yourself dividend versus T4 income, like all that it's always been fascinating for me to learn and get deep into.
I have lots of answers.
Oh, I love it. But let me ask you this.
And the good news, the punchline, it doesn't matter. The punchline is
not what my accountants has been saying. That is not what I've been told all my life.
No, the punchline is it actually doesn't matter. If you want, I'll just give you this one.
Okay, but a lot of accountants say it does matter.
If you want to generate RSP contribution room, you have to have T4 income. So generally what we say is give yourself a salary of up to $200,000. Everything above and beyond can be dividend. And the reason why you're actually indifferent, you're completely indifferent between the two, but for the ability to generate RSP contribution room, the reason you're indifferent is, yes, in pure tax dollars, there's actually a little bit of, there would be a little bit of savings from doing the bonus, but CPP. The about $10,000 of the employer and employee portion of CPP. I've done the numbers for myself every single way. It's within cents. You're basically indifferent.
I think I'm gonna have to fire my accounting.
No.
Hallie just got a new client here.
One last thing. If you wanted our listeners to walk away with something from today, what would it be?
Oh, that's a great question. I think if I wanted people to walk away with something, I always advise clients and people that I speak to go back to goals and objectives. I'm sure that you do the same in the wealth management space. It's very much relevant in the world of tax planning, accounting.
Yeah.
Go back to goals and objectives. What are we trying to do here? Make sure that the structure or the plan that you've come up with actually is solving for what you perceive the challenge to be, or the issue, or the end goal. And it is absolutely possible to plan for all of these different things. Doesn't mean it has to be done right out of the gate.
And it doesn't mean it can't change along the way, right? So that's the beauty. It's getting the mindset of where should I start and let it unfold. Thank you so much, Ali. This has been wonderful, and we'll have you back next time.
Thanks so much.
Thanks, everyone.